It's pleasure to be here.
Yeah.
And good evening to you all. What very first time we are presenting ourselves in front of uh, to the students, to the core community, to make them understand what we are, how we are developing, and who we are. So let me introduce myself. Myself Manish. I have almost 22 to 23 years of work ex with core competency in FMCG and larger in organized retail with Future Group for 7 years, and then Walmart for 6 years as an market head, and then last assignment was with Metro. Uh, I always had a kick to have something on my own, and then fortunately I met Shruti through our common friend. Initially, I joined hand with Shruti as an consultant, but the way I could see a female driving things on her own, being in the industry, is amazing with Shruti. She has been a ITN gold medalist with MBA from Harvard, and also post that she has worked with Bain and Company. Uh, Very strong hold in VC community. So this is what advantage probably we have. One is core competency in getting the VCs interested to understand this concept, and also understand how do we drive it larger. And probably I come with a lot of experience and exposure to serve the community, which is we are talking about tier 2, tier 3, tier 4, where actually availability is a big challenge, one, and price parity is very very high. So what we understood, we understood these challenge, and then we started our e-com distribution channel a year back, less than a year back. And we have created almost 5,000 plus customers, plus almost with 6,000. We are very focused on category at this point of time, which is highly in demand, almost everybody's requirement, which goes like personal care and other categories, and have a faster frequency of buying with those set of customers, so that they can be attached to us. So one, what we're doing, where we're creating a distribution channel to cover up the availability factor of those areas and also remove the price parity. How we are doing through a e-com channel, and then probably Shruti would take over to make you guys understand how we are developing these channels, what we are looking for in future, and also will be a little focused on uh, the VC point which we have discussed in the past.
Right.
So hi everyone, glad to be here and to be of help, right? So as Manish mentioned, my background is in consulting and finance. And I've spent a lot of time looking at entrepreneurs who were starting up various businesses. And my desire was that I should also start something of my own, right? So that's how this journey started. Post getting my MBA from Harvard, I came back to India and I actually launched a travel business. And we started to understand how to sell in India, how to build products in India, how to hire a great team. Post the coronavirus, right, pandemic, we decided to flip the model around to look at like new things. So we actually shifted to like looking at how can we do distribution of FMCG. So the way that I want to run this session is, right, that we've introduced ourselves to you. So you know our backgrounds, you know what work we've done. I'll take you through what does a typical VC pitch look like, right? So what do like we share with VCs when we talk to them? And at the end of it, you can like kind of like share any questions that you have with either Manish or me. So I hope that that works for everyone, and we can use the chat, right? So you can use chat, or we can unmute ourselves to ask questions at the end of the pitch, right? So just to start off, right, when it comes to startup and entrepreneurship, I think the very simple question to ask yourself is that, is there a problem that you understand deeply? And is there something that you're like very interested in solving, right? It's going to be a long journey, 5 to 7 years. It's going to be hard, right? Like you may have money at some points, you will not have money at other points. And it's going to be like super, like culturally different. You will not go to a corporate, with a very set pattern. Key at 6 months, here's your appraisal. At 1 year, here's your bonus. That's not how a startup goes, right? It's a very different life, especially if you are founding. So there's a lot of pressure on you to raise money, a lot of pressure on you to crack a challenge that even others in the, other old companies in the field have not been able to do. And there's a lot of pressure to actually like, deliver value to the customer. So the first point is that if you are starting up, a good question to ask yourself is why? Why do you think that you can start up when no one else has been able to? Why would you want to stay in this for 5 years to 7 years? And post that, right, you need to scope out the problem. So any typical VC pitch looks at how large is the market, right? How large is the problem that you're going to solve? What is the solution you're building? Why is it different from others? How are you the best team to solve this? Early stages pay, if you are able to cover these questions, then you're set. So now I will take you through what is the pitch we give to people, right? And given the early stage that Manish and I are at, the first slide literally that we show people is a team slide, right? Manish has 25 years of experience in FMCG. I have 8 years of experience in finance and product. So we are the right team to come in and build a new technological product that wants to change how FMCG is distributed in India, right? So then immediately venture capital or anyone who's giving us money, has confidence that we understand what we are trying to build and we understand the market very deeply, right? So the team becomes the first important thing to put out. The second is kind of like the problem definition itself, right? So at Apna Club, what we are trying to do is create a new age distribution system. Why? We think that the problem is that outside of tier 1 and capital city markets, there is no organized distribution channel. So if you have a brand, right, if you have a company and you have gotten good response from customers and you decided now I want to launch in Bihar, now I want to launch in Uttar Pradesh, now I want to launch in Tamil Nadu, and I want to access rural and semi-urban and tier 2, 3, 4 towns, there isn't actually like a good way for you to launch your product. If you wanted to launch it on like e-commerce, you can choose Amazon, you can choose Flipkart, you can create your own website and put that up. If you want to do it in a capital city, you can open your own store and try to cater to people in a hyper-local way. So there are a lot of like distribution channels available in cities and a lot of distribution channel available if you're large, right? Agar aap HUL ke size ke ho, aap ITC ke size ke ho, then you can basically go out and you can access distributors and traders. So what happens is that in India, every year $100 billion worth of FMCG goods are consumed, and 85% of this actually goes through these channels, which are very non-organized, right? So a simple brand cannot go out and access them. You cannot find them if you look for them on the internet. Okay, I want to distribute my chocolate in Bihar. Who can I work with, right? So it's the industry is very unorganized and at an early stage now. So what we are looking at is that out of this $100 billion of like consumption every year, there is about $50 billion that flows through semi-urban, tier 2, tier 3, tier 4 India, and it flows through the wholesaler, trader, distributor channel. So we want to organize this channel. We want to equip everyone over here with digital platforms that will transform the industry. Currently, what the industry looks like is this, right? So a brand goes and sells to a trader. This trader sells to multiple other traders until they reach like a geography-based wholesaler. Wholesalers are sitting in a mandi or in a trade market. They come up. So shopkeepers come up to the wholesalers, pick up the goods that they need and go back. Now, what is the issue in this? One, brands and wholesalers, they're only able to provide limited service to the kirana stores. Because wholesalers are buying everything directly, they're taking a risk. So they will never buy new products. That is why new brands cannot use these wholesalers, right? They will not take the chance that I might buy 2 lakhs worth of like your product. And if no one buys it, what happens to my money, right? So the first issue is that wholesalers as a channel, because they are doing outright purchase, new products cannot go in it. 2, when brands actually reach out or sell through wholesalers, they don't know where the ultimate product is going because the product is going, so like, let's say the brand is Colgate. Colgate sold 100 cartons to Trader One. Now, Trader One will sell 20 cartons to someone based in, like, let's say Tamil Nadu, 30 cartons to someone based in Delhi, 40 cartons to someone based in Mumbai. So what happens, the company actually does not know where these goods are getting consumed. So then the brand does not know what is being used where, what is the consumption preference, what is the SKU preference for different areas, right? And for Kirana stores, they don't get credit, they don't get doorstep service, they don't get range, right? They don't get a multiple number of articles to choose from. Now, you and me as consumers can go to Amazon and look up what do we want to buy. But these shopkeepers cannot go on an Amazon like website and choose what they want to buy, right? So right now, B2C customers have it easier. They have better service than B2B customers do. So what Apna Club does is we solve this problem. So 50 billion worth of a market, deep problems in it. We are solving it how? We are creating new sales partners in these remote areas, right? So you take this person, this is Gurpreet Sethi, he lives in Rishikesh. He's already a wholesaler in soap and hair oil, right? So we find him digitally. He downloads our app. On our app, he can now start to find B2B deals, right? So deals for businesses and shopkeepers to buy, and he can access like 300 SKUs. He can access training, right? So he can get trained. How do I sell shampoo now? How can I sell confectionery now? How can I sell tea now? So he'll get access to webinars. He'll get access to a WhatsApp group and community where he can discuss questions. He gets access to a POC, a person of contact from the company, who trains him on what to like sell. And he can also start to manage his orders on this app, right? So, okay, I sold 10 cartons of like Colgate to someone yesterday. I sold 15 cartons to them a week ago. So in another week, I should say, I can try to sell them this item again. So they start to get the basics of a sales CRM that they can use. What happens over here is basically the Apna Club app and Gurpreet Sethi, the sales partner on the ground. Together, we are creating a direct line from the brand to the Kirana store in tier 2-3 markets, right? We're taking over a lot of functions that used to be distributed. So order aggregation, handling the inventory, getting it transported from the brand to the ultimate customer, providing the capital for investing into the stocks. All of this becomes part of what we do. What partners have to do only is to do sales and customer service to their end customers. We work with a number of different brands, right? So we have already started to like run this model with national brands like Himalaya, Unilever, Mini, and we are introducing challenger brands, right? So as I said, if you have a new brand, they have not been able to access these channels yet. So we have proof that we are able to create a new kind of distribution where new brands are able to use this and get distribution into like semi-urban and rural markets. And what is our ultimate vision, right? In 5 years' time, we want to build a network, right? So there's like about 3 lakh small and medium enterprises and entrepreneurs who basically run this wholesaling and trading kind of business. We want to aggregate all of them on our app. We want them all to be part of a community. We want them all buying from us. When everyone is buying through us, we become aggregators of the overall commodity. And so we can ask for better prices for them, right? So just like a cooperative, we are able to band together and ask for better rates on packaging, on logistics, on supply itself. Then as they start to do multiple transactions with us, we can start to give them credit and charge them on the credit. As the community forms, there are people who will want to advertise to them, right? So like, let's say you're a brand, or let's say you are a service provider, then you will want these media, SMEs to like read your advertisements. So then we can monetize that. So we can show them these ads and charge them for it. So that's how the model is building up. First, we put the community together where they're ordering and selling on our platform. As the community matures and they start to do transactions, we'll offer credit as well as services on top of it. So that's how we make our money, right? So we make money by selling them goods. We make money by offering them loans. We make money by giving them advertising services. So that's how a typical VC pitch goes, right? So you lay out kind of like the problem, the solution you're building, why you are the right team for it, and what are the kind of like operating model and moats in the business that you're building. So I'll stop the PPT over here and open up the floor to basically questions.
So I think we have also talked about
Manish, you're on mute.
So I think Shruti has briefed you very well. We also have talked about, right PMF, which probably a VC definitely looks into that. Right product market fit is there. 1, 2, what is the scope of its growth? So you can grow it faster. Could be a sustainable business, right? So and how are you building a strong team? So it's a game of a teamwork also, the kind of business which you are building up.
So let's open up to questions now. Pawan, if you want to take over.
I think you're mute, Pawan.
I'm sorry, I did not know.
That's okay.
So there is a startup from our students which is into robotics. So they started last year and they are looking at raising some funds now because they want to scale their venture. And in that connection, I actually, Sheersh, one of the founders, is right now with us already. I'll just check that if he is. Sheersh, are you there? Hello? Sheersh?
Sheersh Pandey.
Sheersh Pandey, yeah.
I think he's there. He's there.
Okay. So a lot of students who are right now a registered firm now, but right now they are really struggling with finances, and that is where they are stuck a little bit. They're trying hard to prepare their pitches, and they're trying hard to reach out to the investors, but at the same time they fear, that they get into the wrong trap, and something does not go wrong, because it has happened earlier with previous students. They were some private investors who gave a lot of lalach, and then they with an office in Delhi and all that, they went there. But then after that, once everything started and got operational, they came up, that 75% of your companies, this thing would be ours, because everything is ours only. हम ही पैसा दे रहे हैं, तो हम ही 75% तो हमारा ही होगा.
Correct.
That is what
I think creating a pitch
Good
is
evening,
also
sir.
creating a pitch is also an art, Pawan. And see, I would not have been created such chaos or probably such a hype until Shruti would have supported us with so strong a concept and with so much of a strong connect also, because I can build up a business very, very strongly, but probably a connect like this helps a lot, or probably creating a smart pitch which creates an investor interest would create a lot of sense. Yeah, Shruti.
absolutely. Vaibhav,
Hello, sir.
yeah, Vaibhav, is it Vaibhav? Hello. One second, I'll just...
Yes, sir. Good evening, sir.
So, Shruti ma'am,
Very good evening, sir.
Are you able to hear this?
Yeah, I can hear him.
All right. So, Vaibhav, yes, you are audible. Go ahead.
Sir, I am getting little glitches from your side. I'm not able to hear perfectly.
Okay, but we are able.
Sir, I'm rejoining again.
Sure.
Okay.
So in the meantime, right, to address the question of how do you actually create a pitch and who do you reach out to? So there are two kinds of people that you can reach out to at the start of a, sorry, there's a little bit of an echo.
Shruti ma'am, one second. Manish sir, can you go on mute?
Yeah, I'm on mute.
Yeah, I think he's muted now.
Okay, fine.
Sir, can you hear me now?
Yes, perfect. Yes, I can hear.
Sorry, sir, I'm just switching my profile so that I can get better internet connection.
Okay.
So look, so when you're starting off a business, right, you want to go to like two kinds of people. One is an angel investor who is known for making multiple investments, and they have a track record, right? Either they have a LinkedIn presence or they have a Twitter presence where they talk about the investments, why they invest. They're also like now lots of institutions, right? So if you look at it, there's Delhi Angels Network, Mumbai Angels Network. There is, actually many areas now have their own angel networks. There's Let's Venture. There is like Angel List India. And if you go to these kind of like platforms and pitch, right, you will get access to people who have made a lot of investments and they have a reputation that they want to protect. Right. So if you're going for angel funding, that is, you're going from funding from individuals, first of all, go for someone who has a reputation, right? Who is known in the market for doing investments. Before you sign up anything with them, you should always ask for a recommendation of someone that they have worked with, right? So if they're serious investors, they'll already have funded a number of companies and their founders will be able to talk to you and tell you what kind of experience they've had in working with them. Second, typically any kind of initial investment, right, at a very early stage of the firm comes like if you get money from a good source, you basically may dilute anything between 25 to 35%, right? If you're diluting more than that, you really need to ask yourself why you're doing it. Now let's say you're building something in space tech. like maybe you need like $5 million to start off. At a idea stage, if you want to raise $5 million, right, then maybe someone wants like 40% of a company, 50% of a company. That depends. All of this is a negotiation, right? So you need to like talk to them, and the only thing that needs to be done is have the discussion before you start to work with them, right? So 75% is not the problem. 75% as a surprise is a problem, right?
Right.
You should know beforehand what they will take in exchange for all their support, how long the support will last, what kinds of support they will give. And it should be clearly enumerated in like, as far as possible, monetary terms. So they will give you so much office space worth this much. They'll give you hard cash worth this much. They'll give you, access to advisory services worth this much. It should be written down, and you should have it kind of like documented before you start to work with them. Also, always the company owns the IP that you are working on, right? So you don't want to start a company without understanding who owns your IP now, right? So you are thinking, when you're a startup founder at a young and early stage, you are people, right? And you think that your ideas belong to you. The minute you found a company, the minute you put money into it and you start working, the ideas and the IP becomes that of the company. So then you want to be careful who you're letting into your company, right? If someone says they're giving you money, they're basically saying, I want to be an owner with you of your company. I want to be the co-owner of your ideas. So you just need to do your diligence and your negotiations well in advance. And then whatever terms you agree to, right? Now there are industry standard terms. And if you participate in VC circles, if you participate like, the workshops run by like let's say Angel Networks, Pitchy, you'll hear what are the typical terms. And so then you can calibrate, do I really want to raise money from this individual or not? And whenever you can, you should have choice, right? Let's say someone is not giving you good terms, then you want to have someone else you can turn to who will give you money, so that you're not like, bound to unreasonable conditions. So that's how I would think about it. Also, most large, so again, the second option is VCs, right? Today, a lot of like institutional venture capital funds have early stage programs, they have seed programs, and they will have public handles, right? They'll have public email IDs where you can write to them and send your pitch. So Kalari has an open, like handle, Bloom Ventures has an open handle, Axel has an open handle, Sequoia has an open handle. So you should go to all of these investors. You should create a literal Excel list, partner name, email ID, and have you sent the pitch or not? Have you gotten a response? What stage are the talks at? Now you may send this out to 100, 200 investors and not hear back. That's just the life of a startup entrepreneur, right? But that's what you need to do. You need to start off by creating a list of people that you would want to take money from. You need to reach out to them with your pitch, and you need to record where in the conversation you are with them.
Perfect. That's absolutely enlightening. Yes. This is what
And this in VC community is so strong. The moment they are interested to invest, they will hype you so well that there would be people who would be in the queue to invest in your concept. This is what has happened with us too. So one is how smartly you pitch in front of one or two to start with, and then you create a history kind of.
right, sir.
Sir, I have one question, if I may ask.
Yeah, Vaibhav, go ahead.
Yeah. Ma'am and sir, very good evening, and I'm really sorry for my connection problems and all. I could not be very interactive in that moment. Ma'am, my question simple is, like say, I have calculated my tangible assets and intangible assets, and I've run a valuation of my company. It's approximately near about 75 to 1 CR. So how much X of money is viable for me to ask? In terms of X, if I say, let's say if I'm asking for 5X amount, let's say of 5 CR, so what will be the dilution amount that I'll be looking for, or in the market it is going on the same clauses, or will it be feasible to ask me for 5X or not? And what is the pros and cons of that particular amount? I'm a little confused because I'm getting a lot of inputs, but I'm not getting any clearer answer on this particular topic, ma'am. If you could enlighten me for this, I'll be really grateful.
Sure. Look, if you think that your company is worth 1 crore and you're asking for 5 crores, then you're like signing over 5/6 of your company, right? So I think there's something wrong in your calculation. Your company has to be worth more than 1 crore. And what we do is we look at the future value of like the cash flow. So take that, you expect that your company will like run for the next like 5 years, 10 years. It will generate some revenues, it will generate some profits. These profits will be like, so you divide them by the rate of like kind of like capital raised to the power of like time. So this is a very simple ratio. You can look it up online, right? So you take out the time discounted value of money, and that kind of like brings you back to, like the value of your company currently. Now that's very theoretical. In reality, when you're at the angel stage, right, it's a negotiation. You say that like in the future, my company will be as large as XYZ, like what's the comparable, right? So this is called the comparable analysis method. So we are in FMCG distribution. Who are other FMCG distribution companies? In our case, it's Walmart, it's Metro, it's Udaan. So we can say that we are like these companies, and so we will be worth X amount of money, right, in the future. And so therefore, right now, if you want to join, if you want to invest into me and own a part of my company, then I want at least like, let's say 3 crores for 10% or whatever it is. Then it's a negotiation, right? And that's why at the early stages of a company, you are looking to kind of like look at, what is the amount of money you need to prove out your thesis and move to the next stage. If you're at the angel stage, you don't have a, working prototype, you want enough money to make a prototype and to test out whether or not it's commercially viable. If you already have a prototype and you're looking to make the first couple of sales, and you say, okay, my first revenue milestone is 1 crore rupees. So to get to 1 crore of sales, how much do I need to spend? You're looking to raise that amount of money. And you say that this amount of money, and I will give you between 10% to 25% of my company, because one day it'll be as large as whatever, Amazon, or like, it'll be as large as like Tesla, or it'll be as large as like, Udaan or, Walmart and so on. So yeah, so you need to think about like kind of like, what is the future value of your company, and to own a part of it right now, how much of it are you willing to give away? Have I answered your question? Is that a little bit clearer to you?
Yes, ma'am, 80%. This explanation has sparked me another doubt right now, ma'am. If I may ask you, I have seen a lot of sessions about Shark Tanks and all those pitch deck sessions, where I've seen people asking for, let's say, X amount of money on 10% stake. So it is becoming like 10 times the what amount they are asking for right now. So is this the correct way to do the valuation on the basis of tangible, intangible assets on the worth I am asking for? Or what I have said previously, what you said, 5/6 of the company is correct method, ma'am?
No, so look, the value of a company is 1 crore right now, right? But what is the future value of a company? If the future value, if the value of a company totally today plus like the next 10 years combined is 1 crore, then actually you need to reevaluate whether you want to start this company, right?
Okay.
Yeah. So like, let's say that you think the company will be worth 100 crores in the next 2-3 years. And you're saying that I will give you the right to own part of it right now, right? That's what you're doing.
Yes, sir.
Yeah. So basically like you can say that, my company will be worth so much, and I will give you 20% of it if you give me 20% of this value, right? That's fine. What you are trying to like get right is not the valuation. You have to understand there is no value of the company right now. You have to look at what is the industry standard, which sector are you in, how large can that sector become, and how much can like a person who is owning the company earn from that company, right? So therefore, what will actually end up happening is like, let's say that, you run a software business and you think that you can earn 100 crores in the next year. Now, software businesses have like 50%, 60% gross margin. So therefore, like if in 5 years time, you are at 100 crores revenue of a software business, then you will get valued at, 15 times, 20 times that revenue, right?
Okay.
So what is the company's value then? It's 100 into 15 into 20. And you can look this up. They're public market comparables. Any kind of software company that you will have some public company comparables. So then you tell people in 5 years time, with this kind of money coming in, my company will be worth 500 crores. Therefore, if you want to own 20% of it, then I want at least X amount right now, right? So that's what you are doing. And
basically we are trading on the...
on Shark Tank also, people are mentally doing this maths, right? They're saying, okay, I believe my company will be worth so much. And therefore, if you want to own part of it, then you have to give me 20 crores, 30 crores, whatever the amount is.
Okay. And basically we are trading on the face value of the share price, what we are offering to the investor right now on the same stage.
yeah, you need to forget about kind of like, assets and face value of shares. You need to think only about future cash flow. Okay. And you need to think about future cash flow and revenue multiples or valuation multiples, right? So if the future cash flow of your firm is 100 crores and you will get 50% gross margin, then you can ask for 1500 crores as a valuation. If you are in, like, let's say distribution, like we are, right, then it will be closer to 1x 1.5x of your revenue or free cash flow. So you have to understand what is the revenue and free cash flow of your business plan. Then you have to look at what is the multiple on revenue that you can get for it. So it's not about the face value of the share, and it's not really about, the value of assets right now. It's about the total value of the company given its future cash flow.
Okay. Got it, ma'am.
Okay.
Thank you so much, ma'am.
Sure. Any other questions? Anything you can ask?
I think Dipti is also part of this call. Dipti has worked with me.
So,
Hi,
yeah,
Dipti. And
just wanted to say a quick hi to Manish and Shruti. We haven't met Shruti before, but hi, Manish. It's really nice
Hi.
to see you after a long time. And
thank you so much. I mean, me and Dipti worked together when I was taking care of UP. And before that, Dipti was part of head office for supporting the ops team. So I think with Walmart, it has been a long journey, and you were highlighted like a star.
yeah, my journey was actually much longer.
Nice to see you after a
Much
long time.
longer than Manish's journey. Yeah. Shruti's understanding on investments, and it was just brilliant, amazing. I think Manish, you briefed me about her understanding on that. I loved to listen to her on how you calculate these revenues and how you go approach companies to invest in your startups, etc. It's wonderful. Shruti, it was amazing to listen to you. And while you were presenting, it was actually because it's been an year since I left Walmart, and it was very, very nostalgic to hear the usual vocabulary of retail and wholesale, like, various words. And then the companies you named, I don't know the audience here would be able to relate to companies like Metro and Walmart and Udan and other names you used. So for me, everything was pretty nostalgic after a year. And I thoroughly enjoyed the session. It was brilliant. I'm sure the audience right now, Pawan has called for all these young, brilliant boys. Some of them I have met personally. They are really nice. Pawan was talking about their startup on robotic labs.
Right.
So they are doing some brilliant work, and I think it was much needed because they are young, and apart from that, they really need guidance on bringing investments. So I think session with you must have, I am assuming that, it must have helped them a lot. The rest they will be able to tell, and or how they take up your advice going forward. So I think, Pawan, it will be brilliant for the students. You have arranged this startup, and on this note, I would end. And in fact, I would say that if need be for your students, Pawan, you can request Manish and Shruti to come up again, because it normally happens that sometimes these advice take some time to sink in, and then maybe they will have more questions after a few days, which probably they are not getting right now. So I think Pawan can always request you and Manish for, in case more queries arise, you can come and help these youngsters later, maybe at your convenience.
Or,
So it was
even you guys can mail across,
yeah.
which can be accessed and replied upon.
It was wonderful, Manish, to see all this wholesale presentation, small kiranas, and you can understand how I was relating this presentation.
Correct.
It
Yeah.
was wonderful, wonderful.
Thank you so
Thank
much.
you so much, Deepti. It was great to virtually meet you. I think
Yeah.
just like last kind of like advice, if people are interested in starting up, there's lots of great resources available online now, right? So Y Combinator Startup School, Y Combinator's open source, like kind of like pitch deck and like questions. You should just take a look at them. Many of the questions that you're asking: how do I value my company? How do I negotiate the term sheet? What are standard terms? These are things that either you will find on Y Combinator or Bloom Ventures or Sequoia's website itself. So if you
Okay.
just start off by looking at, like the good VCs and see what kind of advice they give at the early stages, I think, some of this will also get covered over there. So wishing everyone the best of luck, and it was great interacting with everyone.
Thank you.
Thank you, Pawan. Pleasure
Thank
to
you,
be
sir.
here.
Thank you, ma'am. Thanks a ton, actually, for taking out time. Thank you so much. It means a lot for us, for all the student community.
Sure.
Thank you.
Thank
Have a
you.
great day.
Thank you very much.
Thank you so much, sir. Thank you so much, ma'am, for your advices.
Thank you. Bye.
Bye bye. Have a great evening. Bye.
Bye.
Bye, ma'am. Thank you.
Thank you.